Investors and traders frequently stop and stop what they believe to be excellent ideas in theory, but aren't so excellent in practice. Investors might wager on 20 profitable ideas in their lifetime, assuming they even have that many, but this could be a mistake. 3, 5, or 7 could make you wealthy, according to Warren Buffett, but you can get rich by trying one new idea every day. The Buffett rule, which states that you should only focus on 1 or 2 truly great ideas, applies to all facets of life, not just finance and investing. It compels focus, which Buffett is accustomed to. Investors must have a laser-like focus on only their very best ideas. Meanwhile, traders must focus on the systems and trades that best fit their own personalities. According to a quote from him once said, "The difference between successful people and really successful people is those really successful people say no to almost everything, ignore the unimportant, and concentrate on the important." Welcome to 3 Towers Investing Channel. In today's video, we'll be talking about Warren Buffett's 7 smart rules to investing. So if you want to learn the most efficient way to create your wealth, listen to the advice of this famous billionaire that will steer you on a clear path to success. One of the greatest investors of all time, Warren Buffett, has been relatively quiet during the coronavirus pandemic. He hasn't been seeing great opportunities even during the current recession, but it's not because he's afraid. He's still optimistic and told investors to never bet against America. "We haven't done anything because we can't think of anything that would be more appealing," he claimed. Buffett is still as mentally sharp as ever as he approaches his 92nd birthday on August 30, and he has made no mention of retiring anytime soon. Why should he? The stock of Berkshire Hathaway has given investors an average annual return of 20.5% since it first went onto the market in 1965. Do you want to know how he did it? Investors can learn how to create a portfolio that outperforms the market by looking at their investing approach. Here are 7 tips from Buffett that will help you succeed. That doesn't mean you should steer clear of an investment because it's outside your area of expertise. As Warren Buffett famously advised, never invest in a business you cannot understand. But you must be able to accurately value it. Avoid a company if its operations are outside of your scope of expertise. This explains why Buffett was hesitant to invest in technology stocks for a significant portion of his career. Buffett's circle of competence includes financial stocks like Wells Fargo and consumer discretionary stocks like Coca-Cola. However, he took a risk on May 15, 2016 and bought shares of Apple for $109 each. Apple's share price increased by 182% on May 15, 2020 as it closed from 307.71. Not bad for someone who at first refrained from investing in technology. According to Buffett, investors should have a sense of ownership over the businesses they choose to add to their portfolios. The goal of an investor should simply be purchased at a reasonable price. A part interest in a comprehensible business whose earnings are practically certain to be materially higher 5, 10, and 20 years from now. The key to building wealth is to hold investments for a long time. According to Buffett, don't even think about owning a stock for 10 minutes if you aren't thinking about owning it for 10 years. As an investor, Buffett advises maintaining composure. He says, keep in mind that the stock market is manic depressive. Purchasing excellent businesses with solid fundamentals and keeping an eye on the long term will help you achieve this. Markets will rise and fall timely for a variety of reasons, but the majority of the downturns will be only mildly long-lasting. It's crucial to avoid becoming manic depressive at the same time as the markets. You achieve this by focusing on the long term and ignoring the present-day fluctuations in the market. One of the guiding principles Buffett adheres to is to exercise restraint when making business acquisitions. He establishes and upholds his own rules. The billionaire said, "You'll see that we only have a small number of significant equity holdings. We choose these investments on a long-term basis, taking into consideration the same factors that would be important in the purchase of a 100% operating business. 1. Favorable long-term economic characteristics. 2. Capable and honest management. 3. An attractive purchase price when compared to the value of private owner. And 4. A sector of the economy that we are familiar with and whose long-term commercial statistics we feel qualified to assess." It is challenging to find investments that pass such a test, which is one of the reasons for our holdings concentration. Over time, Buffett has maintained the self-control to refrain from investing in businesses that didn't meet the aforementioned requirements. We feel quite comfortable concentrating our holdings in a much smaller number that we do identify as attractive. But we simply can't find 100 different securities that meet our investment requirements. Despite frequently stating that he invests for the long term, Buffett is not afraid to sell if the fundamentals have changed and he no longer has faith in a particular sector. As an example, he sold Berkshire's $4 billion investment in the airline sector in April when the sector was being decimated by the coronavirus pandemic. As to why he sold, here's what he said. "For airlines, the world has changed. I'm not sure how it changed, and I hope it corrects itself very quickly. I'm not sure whether Americans have changed their habits already or will change them as a result of the prolonged period." Even experienced investors can make mistakes, so it's critical to acknowledge them and exit the trade before further losses are incurred. According to Warren, every decade or so, dark clouds will fill the economic skies, and at times it will briefly rain gold. So when downpours like that sort occur, it's intelligent to rush outdoors carrying wash tubs and not teaspoons. Do you still remember the old stock market maxim, "Buy low, sell high"? You'll have plenty of chances to buy excellent stocks at rock bottom prices if you're patient. One reason to make sure you have some of your portfolios in cash is to be prepared to profit from temporary fire sales by having some cash on hand. Index funds are highly favored by Buffett. He values them so highly that he has instructed his trustees to transfer 90% of his wife's inheritance to them after his passing. He explained the following in one of his letters. The trustee should invest 90% of the cash in a very inexpensive S&P 500 index fund and 10% of the cash in short-term government bonds. I think the trust's long-term performance from this policy will be better than most who use high-fee managers. At the 2020 annual meeting, he reiterated the advice, saying, "In my opinion, for most people, the best alternative is owning the S&P 500 index fund." There is no assurance that these tips will enable you to generate an average annual return on your investment of 20.5% over the long run. But it's possible if your area of expertise happens to be growth stocks in the technology sector. They might even return more. However, following Buffett's advice can help you get started on the path to a very lucrative career in investing. And that's it for today's video. If you learned something useful today, don't forget to like and share this video with your friends and family. If you're interested in learning more about Warren Buffett's smart investing strategies, then be sure to subscribe and ring the bell icon to stay updated. This is 3 Towers Investing Channel. See you soon!